Hey dudes and dudettes, I'm Shell. And when I'm not catching waves, I'm chasing sweet dividends. Today we're talking about dividend growth and why it just might be the most underrated engine of financial freedom that almost nobody talks about. Now my buddy Hare, he's out there right now chasing the highest yield he can find. Sees a 12% yield and just loses his mind, doesn't ask questions, doesn't check the payout ratio, just dives in shell first. No shell, just first. And look, I get the appeal. High yield feels like free money. But today I'm going to show you exactly why that's a trap and what to look for instead. Because there is a hidden engine that turns a solid portfolio into a true wealth-generating machine. And it's not the yield, it's the growth. And today we're going to do two things. First, I'm going to show you exactly how dividend growth works and why it quietly destroys the high-yield strategy that has Hare losing sleep at night. And then we're actually going to build a model dividend growth portfolio, 12 stocks, 8 sectors. The kind of slow, steady, compounding machine that does the work while you're out catching waves. But before we get there, we need to understand the engine. Because if you don't understand why this works, you'll bail the first time the market gets choppy. And trust me, it gets choppy. I'm a turtle. I know choppy. Let me show you what I mean. And I'm going to keep this simple because I'm a turtle, not a hedge fund manager. Oh, and hey, before we dive in, this is a good time to remind you that nothing I say here is financial or investing advice. I'm not your advisor. Consult a professional before making any investment decisions. I'm also a turtle. So, swim at your own risk. We're going to look at two portfolios. Both start with the same setup. $2,000 a month being invested, a 5% initial yield, 5% annual price appreciation. Conservative, steady, very turtle approved. And every single dividend gets reinvested, every penny. The only difference between these two portfolios, Portfolio 1 never raises its dividend. Portfolio 2 raises it by 5% every year. That's it. One decision. Let's see what it does over time. Scenario 1. I call this one the stagnant payer. Portfolio 1 pays a dividend, and look, props for that. Most don't. But it never raises it. The stock price climbs its 5% a year. The portfolio grows, but that dividend just sits there. Like a hermit crab who found a shell and decided, you know what, this is fine. I'm done growing. And here's the sneaky part. As the price goes up but the dividend stays flat, your yield on cost actually shrinks. You're getting wealthier on paper, but your cash flow, struggling to keep up. Here's where you land. Year 10, portfolio value, $374,000, annual income, $12,500. Year 30, portfolio value, $2.7 million, annual income, $31,000. Now look, $31,000 a year in passive income is nothing to sneeze at. I've lived in my shell for 75 years on less. But here's the problem. 3 decades of inflation just quietly ate your lunch. That $31,000 doesn't go as far in year 30 as it did in year 1. The engine is running, but it never found another gear. Now, scenario 2. This is where it gets good. Same setup, same $2,000 a month, same 5% price appreciation, but portfolio 2, it raises its dividend 5% every single year, matches the price growth exactly, which means your yield stays a constant 5%. It doesn't shrink, it doesn't erode, it just holds and grows with it. And here's what that creates, a double compounding effect. You're buying more shares over time, and the shares you already own are paying you more every single year. It's like, and stay with me here, it's like the ocean. You're not just riding one wave, the whole tide is rising. Let's look at where this portfolio lands. Year 10, portfolio value. $404,000. Annual income, $20,000. Now check out year 30. Year 30. Portfolio value, $4.3 million. Annual income, $215,000. Look at those year 30 numbers again. Same monthly investment, same time horizon, one small difference in strategy, $1.6 million more in portfolio value, and annual passive income that is nearly 7 times higher. In scenario 1, you have a nice nest egg. You worked hard, you saved, and you built something real. In scenario 2, you have financial freedom, a chicken that keeps laying eggs while you sleep, while you surf, while you sit in your shell and do absolutely nothing. The tree keeps growing, and you're living off the fruit. So why does this actually work? What's the real mechanic here? When you invest in dividend growth, you're not just betting on a stock price going up. You're betting on something deeper, a company's ability to become more efficient, more profitable, more resilient over time. The companies that raise their dividends consistently, they're not doing it by accident. They have the cash flow, the business model, and the discipline to back it up. I always say, and I've had 75 years to think about this, the simplest solution is usually the best one. And the simplest solution in income investing isn't chasing the highest yield today. It's finding consistent growth that compounds while you sleep. Hare is out there right now chasing a 15% yield on some sketchy stock that's going to cut its dividend. Meanwhile, the boring 4% grower that raises it 6% a year, that's the one that changes your life. And yes, Hare, I'm talking about you. Capital appreciation is great for the balance sheet, but dividend growth is what builds a life on your own terms. It's the difference between selling off pieces of your portfolio and living entirely off the income it generates, while the underlying asset keeps growing. If you're on the path to financial freedom, don't just look at the yield, look at the growth. That's where the real magic lives. And that brings me to the part of this video I've been looking forward to, because theory is great, but the proof is in the portfolio, so let's build one. 12 stocks, all dividend growers, 8 sectors, built to compound quietly while Hare is on his 3rd broker this year. And no, this is not a recommendation to go buy all 12 tomorrow. Remember, swim at your own risk, but this is what a dividend growth portfolio looks like when it's designed with intention. Let me walk you through each one. We're starting with the most turtle stock on the planet, Coca-Cola, KO, 3.1% yield. 4% dividend growth rate, raised for 62 consecutive years. 62 years, dudes. Through recessions, through inflation, through wars, through whatever Hare has been through. And honestly, that rabbit has been through a lot. KO just keeps raising it. Next up, Costco, COST. Now I know what you're thinking, Shell, the yield is 0.5%. That's basically nothing. And you're right, but listen to this. People pay them to shop there. A membership fee to walk through the door. It's the most genius business model in retail, and they've grown their dividend at 13% a year for 20 years. Oh, and the $1.50 hot dog, unchanged since 1985. That's not inflation protection. That's a philosophy. McDonald's, MCD, 2.3% yield, 8% dividend growth, 48 years of consecutive raises. Recessions don't close the drive-thru. When times are good, people eat there. When times are bad, people eat there because it's cheap. It's essentially recession-proof wrapped in a Happy Meal. 48 years of raises, and they're not slowing down. 2 names in healthcare. Starting with Johnson & Johnson, J&J, 3.2% yield, 6% growth rate, 62 years of consecutive dividend increases, another dividend king. You used a Johnson & Johnson product today. Band-Aids, contact lenses, treatments, they are woven into modern healthcare, raise their dividend every year for over 6 decades. AbbVie, ABBV, 3.8% yield, 8% growth, 52 years of raises. One of the most compelling dividend growth stories in all of healthcare. They have the pipeline, the cash flow, and the track record, the sweet spot. Now for tech, Microsoft, MSFT, 0.8% yield, but a 10% annual dividend growth rate for 22 years. At 10% growth, that dividend doubles every 7 years. Skinny yield, big future. In 14 years, it's 4 times larger on your cost basis. Nobody is leaving Office. Nobody is leaving Azure. Microsoft is essentially infrastructure compounding while everyone argues about AI. Visa, V, 0.8% yield. 17% dividend growth rate. 15 years of raises, 17%. At 17% annual growth, Visa's dividend doubles in roughly 4 years. And here's my favorite thing about Visa. Every single time Hare Panic buys some sketchy stock, taps his debit card, Visa gets a cut. JP Morgan Chase, JPM, 2.3% yield, 9% growth, 13 years of raises. The biggest bank in America with the kind of institutional muscle that weathers every financial storm. ADP, automatic data processing. 2.2% yield, 11% growth rate, 49 years of consecutive dividend raises. A DP processes 1 in 6 American paychecks. You probably don't think about them. They're invisible infrastructure, the kind of business that quietly becomes more essential every year. And a moat so wide you could swim laps. Next Era Energy, NEE, 2.8% yield, 10% growth, 29 years of raises. NEE is the largest renewable energy company in the world. Wind, solar, storage, the future of power, and it pays you while you wait. Mid-America Apartment Communities, MAA, 4.1% yield, 6% growth, 14 years of raises. People always need somewhere to live. MAA focuses on the Sun Belt, markets that have seen massive migration. Rent money, dudes. Be the landlord without being the landlord. Collect the rent. Let MAA handle the leaky faucets while you catch some waves. And finally, my personal favorite, Main Street Capital, Maine, 6.5 yield. 5% growth, 14 years of raises, and it pays monthly. Main Street lends to small and mid-sized businesses, the companies that don't make the headlines but keep the economy running. Check monthly. It's the closest thing to a passive income machine I've found in 75 years of swimming these markets. So let's zoom out. 12 stocks, 8 sectors, average yield of 3%, growth of 9%. Total return thesis of nearly 12% annually before price appreciation. 3 dividend kings anchoring the foundation. Microsoft and Visa growing fast. Main Street providing monthly income, compounding quietly. While Hare is refreshing his brokerage app for the 4th time today. This is dividend growth in practice. You don't need the highest yield. You need consistency, patience, and time, which as a 75-year-old turtle, I happen to have plenty of. If you want to track a portfolio like this, I use Yielder. Makes watching your income grow genuinely satisfying. Link below. And if this video helped you think differently, share it with someone who needs to hear it. You might just save them from chasing a 12% yield into a dividend cut. Hare, I'm talking about you. Hit subscribe if you haven't. New videos every week. Slow, steady, and always worth the wait. And remember, slow and steady wins the race.